One of the defining business stories for 2025 was really this resurgence and true roaring comeback of mergers and acquisitions globally. And we saw after a quiet 2022 to 2023, deal making rebound strongly in 2024 and then surging forward in 2025 to levels not seen really since the record being hit in 2021. So by the end of 2025, global M&A volumes was on track to reach approximately 4.8 trillion. Um, and again, that represents a roughly a 36% increase over 2024 and makes 2025 the second highest year ever for M&A, second only to the boom seen in 2021. The number of deals worldwide also ticked up about 5%, though the volume jump was much larger, indicating the average deal sizes also grew and more mega deals were struck. So 2025 was characterized by the return of the mega deal through Q3, and the number of 10 billion plus deals globally reached about 27, up from 2020, up from 21 in the same period for 2024. And again, a lot of investment banks surveyed signal growth optimism, with many deal makers seeing 2025 saw 2025 as a potential 4 trillion plus year quite early on, and a prediction that did realize and even exceeded that expectation. Now, I want to take a moment to also then consider, and looking back on the year, what are the drivers of this resurgence? And in a later session, we'll look at what we're thinking is going to happen in 2026. But multiple factors really converged to make 2025 a boom year for M&A. First, and we've covered this in other episodes, but the macroeconomic conditions improve. So stable growth, falling inflation, and cost of capital easing of peak levels created a more favorable backdrop. We saw corporate earnings were generally strong, and equity markets rallied, so bolstering confidence and giving acquirers valuable stock currency for deals. A McKinsey review also noted that many of the dynamics that stymied deal making in the previous 3 years, pandemic disruption, high uncertainty, expensive debt, were receding. So significant tailwinds were playing for a very bullish and putting forward a very bullish case for 2025. Secondly, companies had cash and capacity. So global corporate balance sheet held an estimate of about 7 to 8 trillion in cash by late 2024, and management teams were under pressure to deploy that capital for growth. Many firms had posted acquisitions during or postponed acquisitions during the pandemic, and early inflation shocks focused on organic measures. So by 2025, there was a pent-up strategic demand to pursue transformative deals and fill portfolio gaps. In sector after sector, from banking to life science to energy, companies face the need to adapt their portfolios and acquire new capabilities, digital technology, renewable energy assets, etc., to remain competitive. And this created strong strategic rationales for M&A. A third factor was leadership's mindset shift. M&A was increasingly seen as essential rather than optional. And we saw this through a BCG report, also noted that strategic M&A is no longer seen as risky or optional, but it's critical for executing business transformation and achieving ambitious growth. So executives, I think, grew more comfortable pulling the trigger on big transactions, especially as they gained confidence that the worst of the economic volatility had passed. Year two boardrooms, I think, showed conviction. The resurgence of large-scale deals was described as a strong leadership signal. Big deals don't move without conviction, and conviction comes from the top. So, in short, CEOs and boards were willing to make bold moves in 2025 in a way they hadn't in previous years. Another major driver was technology disruption, especially AI, which spurred deal making. I think 2025 saw really a frenzy in deal making in the technology sector. much of it orientated at acquiring AI talent, data capabilities, and software assets. Year two, a Bain report noted tech M&A volumes jumped by about 75% year on year, so making technology the leading sector for global deals. Many of these deals were, well, of course, high profile. So we had Alphabet, Google's parent, made waves with a $32 billion acquisition of Wiz, a global security and AI company aimed to bolster its cloud services with advanced cybersecurity powered by AI. You saw cybersecurity consolidation continuing through Palo Alto Network agreed a $25 billion takeover of CyberArk, integrating identity security into its platform. In the realm of AI research and infrastructure, SoftBank invested about $40 billion in a significant stake in OpenAI, so providing capital to leading AI lab, following its governance turmoil, and positioning SoftBank as at the forefront of AI development. Similarly, we saw Meta, so Facebook's parent, pouring about $4 billion into Scale AI, a startup specializing in AI data and model training to accelerate Meta's AI initiatives. By one estimate, almost half of all large deals in 2025 were AI driven, either acquiring AI native companies or explicitly citing AI synergies as a motivation. So here too, we see this underscoring of how critical acquiring innovation has become, and companies do not want to fall behind in the AI race, where they were really willing to pay top dollar for the right target. If we move to sector and regional trends, yes, while tech led the charge, M&A rebound was broad-based across industry and sectors. Here too, if you look at Bain's analysis, found that all major industries and geographies saw deal growth in 2025, often double-digit percentages. So besides technology, the advanced technology and services sector was also a big contributor to strategic M&A. Again, year two, a headline example could be the monumental railroad merger in the US. Union Pacific proposed an $8.5 billion acquisition of Norfolk Southern, which was announced mid 2025. This deal aims to create the first ever coast-to-coast freight rail operator in the US, combining networks linking the Pacific and the Atlantic for seamless cargo transport. If this is approved, it would be the largest rail merger in history, so forming a giant with a $250 billion enterprise value. So importantly, this merger was made possible by shifting in the US antitrust policy. So the Trump administration more permissive stance on consolidation, including installing new regulations to open to a more deal-friendly environment. So effectively opening the door for mergers that were previously considered unlikely. In fact, Union Pacific's timing was very much driven by the political climate. Industry observers noted that companies likely believe the current political climate is much more favorable to align to big mergers than in recent years. So here too, we see that the rail deal still faces, of course, a lengthy review process, probably another 16 months. But the opposition from labor unions, they're concerned around safety and job losses, still needs to be looked at. But its outcome in 2026, 2027 will definitely be closely watched. And if it's announced, it reflects 2025's unique environment. So leaders saw this opportunity and seized it, making bold bets that new regulators will bless what was previously thought as unthinkable. Focusing on M&A, but looking at Europe, year two, cross-border combinations picked up speed. Cross-border M&A is another specific focus area we might pick on a little bit later in a future session, but also very interesting to look at. And Europe demonstrated this. So beyond the the Airbus Leonardo space joint venture, there were notable acquisitions in energy and materials as companies sought to scale for the green transition. For instance, in utility sector, several European power companies engaged M&A to acquire renewable energy portfolios across borders. So large French utilities buying wind farms in Eastern Europe. Again, a fictional example, but something to illustrate what could transpire from a deal making perspective. Deal values in countries like Germany, Italy, and the Nordics rose significantly. Germany up by 45%, Italy 28%, Nordic regions 31%. And again, this is also partly due to this big ticket deals being seen in each. The UK, while seeing an overall drop, still had mega deals, such as the major grocery chain mergers and telecoms consolidations. So again, here too, meanwhile, Asia and the M&A story was nuanced. As we saw, Asia Pacific value fell, but within Asia there were also hotspots. Japan, outbound and domestic deals, and in India's rising M&A market with a couple of multi-billion-dollar deals. China's domestic M&A was active in the sector. Consumer and industrial and even cross-border deals now involving China dropped due to some of these geopolitical constraints. Another theme was Middle East sovereign wealth funds deploying capital in global deals. 2025 saw Gulf-based SWS participate in several large transactions, such as funding consortium behind some football club deals and also in private equity and alongside private equity and also infrastructure. And again, these oil-rich investors took advantage of high oil revenues and lower asset prices in some of the markets and made some strategic investments, reflecting the ongoing trend of emerging market capital influencing global M&A. Within M&A, we also have to then consider private equity and specifically private equity's role within this. Crucially, I think financial sponsors of private equity venture capital help fuel deal making also rebound. So after a much quieter period, private equity deal making trended higher in 2025, aided by better financing conditions. Year two, again, a BCG report highlighted the global PE deal value was up about 38% as of between Q1 and Q3 2025 versus the same period in 2024. So firms have been sitting on the sidelines due to expensive debt and valuations gaps have now come to market. So although fundraising for new PE funds have been tight, PE firms still had 2 trillion of dry powder, uninvested capital as at late 2025. So this huge overhang of capital, some of it aging and nearing investment deadlines, put pressure on PE general partners to put money to work strategically, and they did. Buyouts of publicly traded companies picked up, as did carve-outs, so PE firms buying divisions spun out of corporates. The leverage buyout market volume also globally jumped. 2025 saw some of the largest take privates in years. So Blackstone 16 billion acquisition of Australian data center operator AirTrunk, Silver Lake's 13 billion take private of Endeavour Group were among top LBOs for the year. And these deals underscore that despite high interest rates, financing was available for high quality assets, especially as lenders grew confident in rates that peaked and that credit markets loosened a bit. Additionally, we saw the initial public offering market reopening as well, at least to an extent in 2025, allowing PE firms to consider exits via listings. A few bankers noted the improving IPO market really helped some of the larger assets in the sponsor portfolios finally find their exit, which in turn gave private equity more confidence to acquire new assets, knowing that they have an avenue to monetize in a year, 2, 3, 4 time. So in summary, what we saw 2025 was an M&A boom, was broad and multifaceted. Corporate sponsors alike jumped back in, mega deals returned, and virtually every region saw notable traction still North America leading the pack. Deal rationales were heavily skewed towards growth and transformation, so scope transactions rather than cutting cost. But we saw a Bain report detailing that 60% of big deals in 2025 were scope deals aimed at revenue growth, making it a record year for growth-driven transactions. This marks a shift from prior waves in M&A that were dominated by consolidation of scale or efficiency. In 2025, companies sought acquisitions to reboot strategy, reinvent themselves, and AI disruption and shifting profit pools. So a fascinating data point, despite the flurry of deals, company as a whole still allocate a relatively small share of their total available capital to M&A. So Bain estimates that capital allocation to M&A was actually at a 10-year low in 2025, as firms also channeled funds into capex and R&D, so internal investment. And this indicates even more room for M&A to grow if confidence remains high, since many firms were still cautious and had plenty of financial firepower and financial reserves to make additional investments. I already touched on some notable deals, but what I want to just also briefly do is touch on some notable deals, but then pick out what some leadership lessons could be that we learned from some of the deals taking place. So, just referring back to the Union Pacific Norfolk Southern deal, again they announced it mid 2025. This deal would create this US retail behemoth spanning east and west coast, but it highlights how timing and regulatory strategy is crucial to deal making. Previously, regulators were opposed to further consolidation, but the company CEO sees an opportunity with the new administration. And the lesson is savvy leadership, monitoring the policy environment, and acting when the window's open. So yes, this deal also carried governance concerns, integrating two organizations and addressing stakeholders, specifically union concerns. A prior 1990s rail merger had led to service meltdown. So leadership lessons is that execution and operational governance post merger is as important as the deal itself and as the deal approval. And the company has actually set aside $2.5 billion breakup fee and a plan for a lengthy review reflect the prudent risk management of the deal structuring. If we look at Google, and here was the 3.2 billion acquisition. This was one of the largest tech acquisitions of the year, aimed to strengthen their cloud security via Wiz's AI-driven platform. And here too, it underscores the trend of tech giants doing M&A to acquire innovation and talent that they cannot build fast enough internally. So the lesson here for leaders is the importance of being bold and pursuing new technology, even at high valuations, when it's critical for future competitiveness. It also shows the need for speed. Smaller innovators can disrupt big firms, so incumbents often opt to buy rather than to build, to be able to stay ahead. SoftBank's investment in OpenAI. So in the wake of OpenAI's late 2024 internal turmoil, SoftBank's massive investment provide funding and possibly steadier governance for AI Lab. And this, again, situation highlights a different kind of deal, a strategic investment with influence rather full acquisition. So the lesson here involves governance and leadership in the cutting edge field. So OpenAI's boardroom saga, where the CEO was briefly ousted, then returned after employee and investor backlash, showed how poor governance can threaten the organization's mission. So SoftBank's infusion came with presumably some oversight in terms to prevent future instability. So for leaders, the takeaway is that sound governance frameworks and stakeholder management is vital, especially in a mission-driven and founder-led companies. Also, big funding deals like this illustrate that non-traditional players like your sovereign wealth funds, etc., and large conglomerates are ready to step in to support transformative tech. So corporate strategists must therefore anticipate unconventional competition, but also partnerships in deals going forward. Mars Inc. Looked at Kellanova, a 36 billion rand consumer product deal. So in the consumer sector, the deal was Mars's acquisition of Kellanova, a snack business spin-off that includes cheese and etc. And this exemplifies conglomerate refocusing, and the opportunity for family-owned or PE-backed buyouts to snap up assets. So the lesson here is portfolio reshaping continues across industries. Leaders must decide which businesses are core, which businesses are non-core. And Mars bet also shows long-term strategic vision, so diversifying beyond confectionery into broader snacks for them. Another large transaction was Capital One, and Discovery Financial, about a 3.5 billion rand transaction. And so happening in finance. So Capital One's acquisition for and of Discover, demonstrates the financial services sought, or how they can potentially look at scaling through tech, and the lesson here is about scale economies versus regulatory limits. Banks see benefits in combining customer bases and tech infrastructure, but navigate antitrust and consumer protection. So with US regulators easing, a lot of these things become more doable, and so much of these deals become more feasible. And executives in regulated industries learned that importance of engaging policymakers and also shaping that narrative. So while this is not a particular outright acquisition, Airbus Leonardo Tailspace JV, this joint venture is effectively a three-way merger in space division that creates a new company, and it teaches a lesson of collaboration for competitiveness in an era where no single European firm could rival the US or China space giants. So combining forces was the solution, and leaders had to set aside national rivalries and agree on governance for the entity. So the key insight here is sometimes that partnerships, joint venture alliances, etc., can achieve goals that a single player can't, especially in the politically sensitive and high investment sector. Now, these examples, of course, barely scratch the surface of 2025's deal-making frenzy, from energy to healthcare to media, and even sectors that had it in the headlines. Many of the valuable lessons in leadership decision provided us with lessons in leadership decision making, risk management, and strategic foresight. Again, we will unpack a few of these further, but hopefully this provided you with some insight into what 2025 brought and lays the landscape, or the start, when we start looking at what happens in 2026. Thank you for joining, and looking forward to speaking to you again.